Welcome back. Let's talk where the markets are headed from here on. The last couple of days have been spent in a very tight band despite a lot of news flow. We've seen the start of the earnings season. We've seen a few macro indicators as well come and go, but the markets have pretty much been unchanged. Dhiraj Sachdev, the managing partner and CIO at Roha Asset Managers, is now with us on the show. Dhiraj, are you convinced the worst of the price damage is now behind us and probably a bulk of the time correction is behind us and markets are primed for a move? And if yes, in which way, and what would be the big triggers to watch from here on?
Yeah, hi. So good morning. So to start with, we believe that macro issues of high inflation and consequent hike in interest rate appears to be peaking out right now. I mean, the whole of last year and since August 2021, we had issues of inflation, supply chain disruptions, high freight cost, etc., and then consequent rise in interest rates by central banks. These are all definitely getting reversed, which should support the Indian market going forward. Now, if one observes, March headline inflation has moderated to 5.6% after two consecutive above 6% readings. So core inflation too has surprised on the downside. And lower oil and commodity prices are a reflection of inflation trending down. So as such, we estimate a prolonged pause by RBI in financial year 24. Now, on the US economy, given resilient consumers and strong economic data, there is higher probability of the US economy facing only a soft landing versus a sudden crash or a deep recession. However, given slowdown stress in Western markets, we expect emerging markets to find favor. Now, emerging markets are under-owned and asset classes globally and have better growth, lower inflation, and less sovereign debt. So we expect a gradual flight of risk capital from slowing developed markets to relatively higher growth, stable currency emerging markets. And we expect India will be a favored destination for global investors to attract flows. Now, importantly, if you look at it, the Indian economy is witnessing multiple levers of a secular growth cycle. I mean, these include private capex, government-backed PLI program, and sustainability of credit growth. I mean, these are all acting as triggers for the long term. So the credit growth for public sector banks, for example, at 15%, and for private banks at 20% reflect buoyancy in business and consumer lending. So India's domestic consumption will partly offset any adverse export market conditions due to global slowdown. So given this view, we do expect a comeback here of mid and small caps in specific that has underperformed over the last 12 to 15 months versus large cap index.
All right, Dhiraj, we got that point. But, if at a time like this, when the markets are expected to be so range-bound, when you're not expecting too much, at least on the index level, are there individual pockets or sectors where you think, it's perhaps still safe to put some money and expect decent returns? Are there any pockets like that which seem attractive to you now?
So plenty. I mean, our investment strategy obviously is more domestic-centric because export business is very much coupled with global economies. Hence, our portfolio focus is more domestic-centric businesses. Now, themes like banking, financial services, travel and tourism, engineering and manufacturing are interesting opportunities. We do like select pharma and specialty chemicals, which would come back as their profit or EBITDA margins are close to bottom. Maybe fourth quarter results will again reflect cost and margin challenges, but market may have already discounted it. And capital goods specifically, will be driven by capex cycle recovery, and we expect the execution of all cap goods companies and most EPC companies to remain healthy, led by strong order book accretion in the past 5 to 6 quarters.
Okay, Dhiraj, just trying to get your thoughts on consumption, because suddenly there seems to be a different narrative now in the market that rural demand is actually going to start picking up, inflation cooling off. And perhaps that's one reason why some of the two-wheeler stocks have started seeing some traction as well. A lot of the consumer names have started buzzing around. Do you agree with this narrative and this theory that rural is going to pick up? And yes, if you are, then how would you play it?
Well, rural will take its own time, but given the election year for the next few months, we expect that there will be increased spending and consumption. The auto sector has so far has seen a mixed set of numbers for the month of March. I mean, while two-wheelers and commercial vehicle volumes came ahead of expectations, tractor segment volumes were lower lower than our expectations. And demand for entry-level cars remained weak, though SUV is doing well. So we are more positive on the commercial vehicle side of the auto segment we have to play. Consumer durables is still seeing pricing pressure or the cost pressures. Though because of the onset of summers or very high heat wave, we are seeing air conditioning or air conditioners or refrigerator or fans demand to be strong. But they may actually see weak margins on account of higher cost and intense competition. So we are very selective, and we don't see too much of an earnings upside in most of the consumer durables or neither in the consumer staple businesses because of higher valuations.
Where do you stand on IT, Dhiraj? Based on what we've seen from large cap names like Infy and TCS, does this throw up an attractive buying opportunity right now? Or wait it out?
No, Rima, I think we need to still wait it out because see, the slowdown was sharper than expected. I mean, there was deterioration in demand from US with discretionary programs that were paused or cancelled. I mean, Infosys and TCS reported sequential decline in US market. And the revenue decline in North America was across verticals. So we believe that the IT sector will still take some time because of the demand uncertainty and could impact even in the June quarter or September quarter results possibly. So longer term, we all agree that the cloud-based applications and big data and IoT are interesting opportunities. But we think that the sector will underperform in the near to medium term due to growth and demand uncertainty in US.
All right. Dhiraj, just one final question. Do you feel like any of the new age companies are worth looking at now? We were just talking about Paytm a while ago as well. There's a brokerage note that has come out. Do you think any of them have seen valuations correct enough for you to be comfortable?
The valuations of new age companies have corrected, but while they are disruptive companies, many are still in the cash burn stage, and valuations, despite correction, are ahead of time and offer little margin of safety. So it is possible that some of the disruptive businesses can themselves get disrupted, and only a few will survive to make it big. So we will continue to be cautious, though we'll monitor progressively how the margins and the cash burn stage reduces. So yes, a couple of them can be interesting opportunities, but we are still too early in the game of new age tech companies.
It's still too early in the game. Dhiraj, thanks a lot for joining us with that quick chat. Very interesting to get your thoughts as always. With that, we are going to get into a short break. The market is still absolutely flat, but it has moved into the green, around 10 points higher. The Nifty Bank is up a little bit right now, so around 140 points higher on the Nifty Bank. Let's take a short break, but when we come back, we're going to speak with Manish Gupta of CRISIL to discuss the telecom company's post-paid push. Stay tuned for that.